So once again, welcome back to the session, everyone. So in our last day's session, we have started with the area of AA, and we discussed about the most important area in our syllabus, that's the area of substantive procedures. And in our today's session, we will be focusing on three core areas. So the first one will be the area of reporting. Then we will be focusing on the area of ethics. And finally, we will also be focusing on the area of corporate governance as well. So these are the three areas on which we are going to focus now. So starting with the area of reporting. So basically when it comes to the area of reporting, you will be getting 5 more questions based on reporting for our exam AA. So basically when it comes to the area of reporting, the examiner might be asking you to form opinion on the company's financial statements, and they will also be asking you about the impact that will be created over the auditor's report if any of the mistakes in the financial statements are uncorrected. So in that case, you need to determine which opinion you need to express as an auditor, and again you need to discuss why you are requiring to provide that particular opinion on the financials. So to determine which types of opinion that we need to express over a company's financial statement, the first thing is that we should be having proper understanding on the types of opinion. So basically there will be 2 types of opinion that will be expressed over a company's financial statements, which includes modified opinion and there will also be unmodified opinion. So basically there will be 2 types of opinion. One will be modified opinion and the other one will be unmodified opinion. And the modified opinion can be further classified into qualified opinion, adverse opinion, and disclaimer of opinion. And the unmodified opinion will be further known as unqualified opinion, which means that the company's financial statement shows a true and fair view. So basically when it comes to the unqualified, as we mentioned earlier, we will provide this sort of opinion only when the company's financial statements does not have any mistakes, which means when a company's financial statement shows the true and fair view, we shall express an unqualified or unmodified opinion. Or when the company's financial statements is having many mistakes, the company's financials does not show a true and fair view. So that is the point where we will give adverse opinion. However, when there are some set of mistakes, but the financials are not fully misstated. So except if those factors are avoided, the rest of the financials will show true and fair view, and that is something called qualified opinion. And there will be rare situations where the auditor will not be able to obtain sufficient appropriate audit evidence. And due to this lack of audit evidence, auditor will not be able to form a proper opinion on the company's financial statements, and this will give rise to disclaimer of opinion. So the disclaimer of opinion will be expressed only when the auditor is not able to form an opinion on the financials due to the lack of audit evidence. So unqualified will be provided when the financials shows a true and fair view. Adverse opinion will be provided when the financial statements does not give a true and fair view. And qualified opinion shall be expressed when the financials shows true and fair view, but except some factors are avoided. And disclaimer of opinion shall be provided when the auditor is not able to express an opinion on a company's financial statements due to the lack of audit evidence. So these are the kind of opinion that we can express over a company's financial statements. Alright. Then, now we need to understand the situations where we need to give either a modified or an unmodified opinion. So basically consider that there is a mistake in the company's financial statements. So the company have not included an interest expense. So the interest expense is amounting to $20,000. So if the interest of $20,000 is not included in the company's financials, and the auditor have requested the management to include adequate disclosures relating to this interest expense, and they have also asked to include proper expenses in the company's financials, and the company is unwilling to do the same. So in that situation, we can consider it as an uncorrected mistake. So due to this uncorrected mistake, we might need to express it over the company's financials. So the first thing that you need to consider is whether this amount of 20,000 is material, and we need to consider whether this amount is pervasive. So we need to consider the materiality as well as the pervasiveness of the amount to consider whether this amount is properly included in the financials or how we need to reflect it over the company's auditor's report. So to consider whether an amount is material, we can consider certain benchmarks. So it can be taken either on the basis of statement of financial position or on the basis of statement of profit or loss. So when it comes to the statement of financial position, we can consider it on the basis of the total asset of the company or on the basis of the net assets. Same as that when it comes to the statement of profit or loss, we can consider either it on the basis of the company's profit or on the basis of company's revenue or on the basis of company's gross profit. So when it comes to the total asset, the materiality shall be considered as 1%, net assets will be 2%, profit will be 5%, revenue will be 0.5%, and gross profit will be another 0.5%. So these are the benchmarks. So basically consider that if a company's revenue is 1 million, in that case 0.5% of 1 million, that is 5,000 will be the materiality. Or on the other hand, say for example, if the company's materiality is computed on the basis of the total asset, consider that the company is having a total asset of 25 lakhs. So in that case, the 2.5 millions 1%, that will be 25,000 will be the materiality benchmark. So in this way, you need to consider whether an amount is material or not. So if the amount of misstatement is more than 1% of the company's total asset, that can be considered as material. So in this situation, the amount of misstatement is only 20,000 and the company's total asset is 2.5 million. So 1% of 2.5 million will be 25,000. So is this amount material or not? No, it is not material, as the amount of 20,000 is less than materiality limit of 25,000. And if the amount of misstatement in the interest was more than 25,000, in that case that will be material. So this will be the way in which we will be considering whether a mistake is material on the basis of its value. And in addition to that, we should also be considering whether a mistake is material on the basis of the nature of the misstatement. Normally, a related party transaction, and in case if there is something which affects the going concern ability of the company, all this have to be considered as material. So we have studied in our regular session, like related party transaction includes transaction with a parent company or with a subsidiary company, transaction with an associate, or transaction with a joint venture, or in case if there is any transaction that is done with the company's key management persons or with the directors of the company. In all these situations, this should be considered as material on the basis of its nature. So this is how we will be considering whether a mistake is material on the basis of the nature of the transaction. Okay. So we will be considering it like this. So we have to consider whether a mistake is material on the basis of its size, and also we should be considering whether a mistake is considered material on the basis of its nature of the transaction. Okay. Then once the materiality is determined, the next thing which we need to consider is a pervasiveness. So we need to consider whether a mistake is pervasive also. So in order to understand whether a mistake is pervasive or not, we should be considering some other criteria mentioned in the standards. So these were the criteria which are mentioned in the standards to determine whether a mistake is pervasive or not. So basically the term pervasiveness is usually used to show the effect of a company's mistake in the company's financial statements, or if the company's undetected mistake create an effect in the company's financials, that will be having an impact. So that can be mentioned using the term pervasiveness. So usually a mistake is considered to be pervasive if it's meet any of these three criteria. If any one of these three criteria is met, then in that case we can consider it as pervasive. So case number 1, consider that if a mistake affects multiple elements of the financial statements, it is not confined to a single element, it is affecting multiple elements of the financial statements. Say for example, if a mistake strikes the company's expense and the company's value of asset at the same time, it can be considered as pervasive. Say for example, consider that if a company have not included proper impairment for an asset, the value of impairment is very significant, and in that case the impairment is not properly recognized by the company, it would result in mistake in the value of company's asset, as the asset will be overstated, the expenses will be understated, and the profit will be overstated. So financials are having multiple implications due to this simple mistake or single mistake. So if a particular mistake is affecting multiple elements, it can be considered as pervasive. Secondly, we need to consider whether the mistake is confined to a single element, but it is affecting substantial portion of that element. Say for example, if there is a mistake that affects the revenue and it only strikes on the company's revenue directly, but the 60% of the revenue is misstated. So in that case also we can consider it as material. Or consider that the company have not included a significant provision, and if the provision amount is not appropriately included within the expenses, in that case it can be considered as a pervasive balance if it is having significant impact in the company's financial statements. And thirdly or lastly, we need to consider whether is it something which affect an important disclosure which is fundamental to the user's understanding of the financial statements. If a disclosure which is very fundamental for the user's understanding of the financials is omitted or misstated, it can also be considered as pervasive. So these are the criteria on the basis of which we will consider whether a mistake is pervasive. So the last one, for example, if there is a mistake that affects the company's going concern ability, or if the going concern disclosures are not appropriately provided, it can be considered as a pervasive mistake. So these are something which are mentioned in the standards. However, for the purpose of attending our paper AA, it is not required to have this set of standards necessarily. Instead, you can use a very simple approach. So when you want to determine the pervasiveness, first of all, you need to consider whether the company is currently in profit or loss. Consider that the company is currently in a profit of 100,000, okay? And there's a misstatement in the company's financial statements. The company have not appropriately included an expense which amounts to 130,000. So what if this mistake is adjusted in the company's financial statements? The company will result in a net loss of 30,000, right? Or on the other hand, consider another company which was already in a loss of 5,000, and the company haven't included an income which amounts to 6,500. And what if this misstatement is appropriately treated? The company will result in a profit of 1,500. In both of this situation, amount of misstatement can be considered as material as well as pervasive. So first of all, you need to consider the materiality, and then you need to consider the pervasiveness. So the pervasiveness will be considered on the basis of whether the profit or loss is restated. Consider that in the case number 1, the company's reported profit is restated into losses after adjusting the misstatements. So in this case, the amount of misstatement will be pervasive. And in the second case also, the company's loss is restated into profit after adjusting the misstatement. In this case also, we can treat it as pervasive. So this will be the way in which we will be considering the pervasiveness of the item. So just consider whether the profit of a company is restated into losses after adjusting the misstatement, or whether the loss of the company is restated into profit after the misstatements are adjusted. In both of these cases, we need to consider that mistake as material as well as pervasive. And always keep this one in mind. We will only check the pervasiveness of an item if it is considered to be material. So first thing that you need to do is that you need to consider whether the amount of mistake is material. Then only you should consider whether that amount is pervasive as well. Okay. And consider that there's a misstatement in the company's financial statements. Okay. There's a misstatement in the company's financial statements. And the amount of misstatement is not material and not pervasive. So you have considered the materiality of the amount as well as the pervasiveness, and it is said to be not material and not pervasive. In that case, you shall provide an unmodified opinion or unqualified opinion. And in another case, there is a misstatement in the company's financial statements which is considered to be material and pervasive. So when there is a mistake which is both material and pervasive, in that case you shall express an adverse opinion. And when there is a mistake which is material but not pervasive, then you shall express a qualified opinion. So this is how you will be expressing opinion on the financial statements. So when there is a misstatement which is not material and not pervasive, you shall express an unqualified opinion. When there is a mistake which is material and pervasive, you need to give an adverse opinion. when there is a mistake which is material, not pervasive, you shall express a qualified opinion. And consider that there is a lack of audit evidence. Okay, the auditor have not obtained adequate audit evidence in relation to a balance. And if the lack of audit evidence is not material and not pervasive, in that case also you shall express an unqualified opinion. If the lack of audit evidence is material and pervasive, then you need to give a disclaimer of opinion. If the lack of audit evidence is not material, not pervasive, in that case you will be giving a qualified opinion. So this will be the way in which you will be expressing opinion on the company's financial statements. So again, I'm repeating one more time. If there is a mistake which is both material and pervasive, then in that case you can give an adverse opinion. If there is a lack of audit evidence which is material and pervasive, disclaimer of opinion needs to be expressed. If there is a lack of audit evidence which is not material and not pervasive, same for the misstatement as well, we will be giving unqualified opinion. And if there is a mistake or lack of audit evidence which is material but not pervasive, in that case you shall give a qualified opinion. So this will be the way in which you will determine which opinion you need to express over a company's financial statements. Okay, fine. Then, in addition to this type of opinion, we are also required to consider paragraphs. So, we have studied about multiple paragraphs which an auditor will use while reporting in the company's auditor's report. So, basically you can consider including emphasis of matter paragraph, other matter paragraph, key audit matter paragraph, other information paragraph, and material uncertainty relating to going concern paragraph. So these are the basic paragraphs that will be used by an auditor. So when it comes to the first paragraph, emphasis of matter paragraph. So the emphasis of matter paragraph is a paragraph which is used by an auditor to emphasize about a matter which is appropriately presented and disclosed in the financial statements. So if there is something in the company's financial statements which the auditor which the client have appropriately presented and disclosed, and if the auditor need to emphasize the same thing to let the users understand the important disclosure or the item, auditor shall include the same thing within an emphasis of matter paragraph. And the next paragraph is other matter paragraph. So basically there will be multiple things that the auditor might need to communicate to the users which are not directly linked to the company's financial statements, but which is directly linked to the current year audit or relating to auditor's responsibility or relating to the auditor's report. So if the auditor need to include any additional disclosures that the auditor need to convey to the users, they can include it within other matter paragraph. Then when it comes to the key audit matter paragraph, the auditor might be communicating some significant things to the companies, those charged with governance during the current year engagement. And out of those matters which the auditor have communicated to those charged with governance, auditor might wish to communicate the same thing to the users as well. So if the auditors need to communicate something to the users which are picked from the communication to those charged with governance, auditor will include key audit matters, and the matters which the auditor need to communicate will be included within this paragraph. And this paragraph is normally used specifically for listed clients. And there's another paragraph called other information paragraph. And we know that the other information means it's the information that is included in a company's annual report. All the financial and non-financial informations included in a company's annual report will be called as an other information. And the auditor is having a responsibility that the auditor need to check the consistency of financial statements and other information. And if the company's financial statements and other information is not having consistency, and in case of that inconsistency, auditor need to consider whether the mistake or the inconsistency is due to issues with the annual report or with the financial statements. And if the issue is with the annual report, that is, if the issue is with the other information, auditor shall communicate the same with management and those charged with governance, and again with the audit committee. And if any of them is not appropriately taking reasonable actions, auditor shall include the same thing to convey it to the users, and the auditor will be using a paragraph called other information paragraph. So the other information paragraph can be used to communicate about the misstatements in relation to other information. But at the same time, if the auditor needs to include anything other than those things mentioned in the company's financials which are relating to other information, shall be included within other information paragraph. The only main thing that you need to keep in mind is that if the auditor is including other information paragraph specifically for the purpose of mentioning about the mistakes in relation to other information paragraph shall be given immediately after basis of opinion paragraph. So that is what you need to consider. Clear? Fine. And again, there is something which is very important. We have got reporting in relation to the going concern. So we have got something to learn about going concern reporting as well, right? So now let's look into the going concern reporting part. Well, as we know, it is the duty of the auditor to consider whether a company's going concern assumption is appropriate, and consider that if a company's going concern assumption is inappropriate, auditor shall express an opinion on that. In addition to which, auditor should also be considering whether there is any uncertainty relating to the company's ability to continue as going concern. And in case if there is any uncertainty relating to the going concern, that should also be adequately disclosed in the company's financial statements. And consider that if the uncertainty relating to going concern is appropriately present and disclosed in the FS, in that case, auditor might need to convey the same thing to the users as well. So for which auditor shall use an additional paragraph called material uncertainty relating to going concern paragraph. The material uncertainty relating to going concern paragraph, or the MURGC paragraph, will be used by an auditor when the auditor need to emphasize about the uncertainty relating to going concern if the uncertainty is appropriately present and disclosed in the financial statements. And consider that if the uncertainty is relating to going concern is not adequately disclosed by the client company. In that case, auditor cannot include an MURGC paragraph, because MURGC paragraph is also almost like emphasis of matter paragraph, which should be used specifically to mention about a matter which is appropriately present and disclosed in the company's financial statements. And for MURGC, it will be specifically the going concern related disclosures, that too uncertainty relating to going concern. And this is what we learned as part of the going concern reporting. So the first one is that if the company's going concern assumption is appropriate, what should be our opinion? If a company's going concern assumption is appropriate, then there is no issues in the scenario, right? So in that case, you can give an unmodified opinion, which is not mentioned here, but just keep this one in mind. If the going concern assumption of a company is appropriate, then in that case, you shall express an unmodified opinion. And consider that the going concern assumption of the company is inappropriate. So if the going concern assumption is inappropriate, then in that case, auditor shall express an adverse opinion. If the going concern assumption of the company is appropriate, but there is an uncertainty, but the company have adequately disclosed about the uncertainty. If the uncertainty is adequately disclosed and presented, then there is no issues. So in that case, auditor shall give an unmodified opinion itself. However, auditor should include an additional paragraph called material uncertainty relating to going concern to emphasize about the proper disclosure of uncertainty relating to going concern. Then, if the going concern assumption is appropriate, but there is an uncertainty which is not adequately disclosed. So if the uncertainty alone is not adequately disclosed, then auditor shall give a qualified opinion. And if the client haven't given any disclosures relating to going concern, in that case, we will be giving an adverse opinion. Then, consider that if the management is unwilling to make the going concern assumption, if the management have not taken assumptions relating to going concern, as an auditor, in that case, we will not be able to conclude whether there is an uncertainty or not, or whether there is any issues in relation to the going concern. So in that case, we will not be able to express any opinion as the company haven't done the going concern evaluation. So whenever we are not able to express an opinion, what will be the opinion provided in that case? It will be disclaimer of opinion. And if the auditor understood the fact that client have done going concern assessment, but some part of the assessment is missing. So if the auditor have requested the client to extend the assessment and they are unwilling to extend the assessment, in that case, we will be giving qualified opinion. And additionally, we have also discussed and studied that whenever a company is mentioning about their going concern assumption, auditor should never be focusing on company's revenue or the company's profit. Instead, the auditor should always focusing on testing the company's cash flows, as the company will be able to continue their operations only if they have adequate cash flows. Okay, so this is what you need to consider as part of the company's going concern evaluation. Clear? Fine. So these are the theoretical area over which you should be having proper understanding to perform questions in relation to reporting. And now we will do one thing. We will look at two questions in relation to the going concern reporting. Okay. So let's go through the revision kit first. Okay. There's a question called Pacific. Okay. So there's a question called Pacific in our revision kit. So we will do one thing. We will read the requirement first. So they have asked us to discuss about the issues and impact on the auditor's report if any of the issues remains unresolved. So they are asking us to discuss about some issues and we need to show the impact on auditor's report if some of the issues are not unresolved. Okay. So let's look into the scenario now. So we need to read the introductory paragraph and they are mentioning some issues relating to the provision for legal claim. So we'll read both of this paragraph and then we will read the reporting part. Okay. So it's a 5-mark question. So it is 1st July 2015. Pacific Company operates a chain of 14 retail stores across the country, selling its own range of cosmetic products. You are the audit supervisor of Caribbean Company. The finance audit is due to commence shortly for the year ended 31st May 2015. The draft financial statement shows a revenue of 45.2 million and profit before tax of 4.1 million. The following 3 matters have been brought to your attention. Okay. So whenever you do the questions relating to reporting, it's important to highlight the profit as well as revenue related figures. Then, now let's read the provision for legal claim part. In March 2015, number of claims were received by the company from customers who suffered severe allergic reactions after using one of Pacific Company's products. They alleged that the product ingredients listed on the label were incorrect. An internal investigation has suggested that one batch of the product has been incorrectly labeled. Finance Director has recognized a provision in draft financial statements of 0.5 million. So it's mentioned in the scenario. So what shall we do in this case? So we need to first of all identify all the important points from the scenario. So it is clearly mentioned in the scenario that the company is having some probable future cash outflow for which the company is required to recognize the provision, and company have already recognized a provision of 0.5 million. So this is what it's mentioned in the scenario. Now let's read the reporting part. During the audit of Pacific Company's provision for legal claim, the audit team gathered audit evidence showing that provision should amount to 0.8 million. Finance Director has suggested that no adjustment is made in 2015 financial statements as he believes 0.5 million is a reasonable estimate and that difference of 0.3 million is not material. So they have mentioned that on the basis of the audit procedures, it is concluded that the required provision is 0.8 million. But they have recognized only 0.5 million. And they are mentioning that the 0.3 million is not material, therefore adequate disclosures are not required or adequate provision is not required to be created. That is what it's mentioned by the Finance Director. So now we need to identify the amount of misstatement in this question. So what's the amount of misstatement? So well, we know that the amount of misstatement is 0.3 million, right? And in order to determine which opinion that we need to express on the company's financial statements, as we mentioned earlier, first of all, we need to consider whether this mistake is material or not. So we have to consider the materiality, right? So the amount of misstatement is 0.3 million divided by, we can calculate the materiality on the basis of the company's profit before tax. The company's profit is 4.1 million. So 0.3 divided by 4.1 into 100. So we need to calculate the materiality first. So everyone please calculate the materiality. So 0.3 divided by 4.1 into 100. So the materiality is 7.317%. So the company's amount of misstatement is 7.31% of the profit. So is this amount material? Yes, it is, right? Because we have already learned here that if the amount of misstatement is more than 5% of the profit, then it should be considered as material. So now we have concluded that the amount of misstatement is more than 5% of the profit. So it's a material mistake. And next we need to consider whether the mistake is pervasive or not. So is this misstatement pervasive? So for which what we need to do? We need to consider whether the profit will be restated into losses once the misstatement are adjusted. As we can see, the company is having a reported profit of 4.1 million. So even if we reduce 0.3 million from the company's profit, will the amount of profit be restated into losses? Definitely not, right? The company will still remain in profit. So in this case, shall we consider this as pervasive? No, it is not pervasive as the profit is not restated into losses. So it's a misstatement which is material but not pervasive. So that's the case here, right? It's a mistake which is material, not pervasive. So in that case, what opinion need to be expressed by the auditor? Yeah, qualified opinion shall be expressed in this case. So this is the opinion which we need to express in case of the company. So this is how we will be reaching the answers for the questions relating to reporting part. So now we have identified the answer. So this will be the impact on the auditor's report. But for 5 mark, examiner have initially asked us to discuss the issue. Then the examiner has asked us to describe the impact on auditor's report. So we need to discuss the issue as well as we need to describe the impact over the auditor's report. Okay. So now what we need to do in this case? So now what we need to do in this case? So the first thing which we need to do is that when we write the answers in relation to reporting, first of all, we need to identify the fact from the scenario. So we need to identify the fact from the scenario. Secondly, we need to mention about the accounting treatment briefly, the actual accounting treatment which is required. Third, we need to mention about the misstatement. And number 4, we need to mention whether the amount of mistake is material or not. 5, we need to consider whether the mistake is pervasive. 6, we need to consider whether which opinion we need to express on the company's financial statements. And finally, we need to show the basis of opinion, which means which opinion we shall express on the company's financial statements. So these are the key points which should be there in your answer. So number 1, fact. So you can identify the fact from the scenario. You can mention that the company is facing a legal action from its customers who have suffered severe allergic reaction after using Pacific Company's products. Therefore, as per IAS 37 provision contingent liabilities and contingent assets, company should have created adequate provision for the probable future cash outflows. However, during the current year, the company have recognized a provision of 0.5 million, but the audit fieldwork has confirmed that the required amount of provision is 0.8 million. But the company's finance director is unwilling to make adjustment relating to the provision, which represents a misstatement of 0.3 million. Then you need to mention about the materiality. The amount of misstatement is material as it represents 7.3% of the profit, and if it is uncorrected, then the profit will be overstated and the provision will be understated. Then you need to mention about the pervasiveness. Even though the mistake is considered to be material, it cannot be treated as pervasive as the reported profit of 4.1 million will not be restated into losses. Therefore, it's a mistake which is material but not pervasive, and the auditor shall express a qualified opinion stating that except for the matters identified in relation to the misstatements of provision, the rest of the financial statement shows a true and fair view. Following opinion paragraph, auditor shall also express basis of qualified opinion in order to mention about the misstatement in relation to the provision and its impact over the company's financial statements. So this is how you need to present your answers. So that will be a complete answer. So you need to literally identify the fact in the scenario. You shall mention about the accounting treatment which is actually required. You need to mention about the misstatement. So the materiality have to be mentioned. You need to consider whether this mistake is pervasive or not. Then you shall include the opinion as well as the basis of opinion. So this is how you need to mention about the answers in relation to going concern. Actions in relation to reporting. So this is the way in which we need to present the answers. So keep these points in mind. So this is how you will be normally getting questions based on reporting. And in addition to which, there are some rare cases of asking questions relating to going concern. You can consider doing the question called Jasmine in that case. In addition to which, there are some questions based on the use of other paragraphs as well. So you have to practice maximum number of questions as possible to get proper idea on each of these area, which we have already discussed in our regular sessions. So please do attend all the other important questions that are mentioned in our revision kit. So this is how we need to learn about the topics in relation to reporting part. Anyway, you can expect a 5 more question from the area of reporting. All right. So once we are done with the area of reporting, another important area to revise is the area of corporate governance. So, well, we know that corporate governance is another important area which will be tested as part of the AA paper. So when it comes to the corporate governance, so these are the principles or corporate governance are the system by which an organization will be directed and controlled in the interest of the shareholders and stakeholders of a company. Well, we know that the company is run by the person who are selected by the company's shareholders. So the owners of the company and those who run the company are different. So there can be chances of having conflict of interest and all. And to avoid all of this, we usually used to mention that every company is preferably required to follow corporate governance guidelines. So these are the principles that should be followed by every company. So for your exam, you will be getting questions on corporate governance area. The examiner might be asking you to pick the corporate governance deficiencies in the scenario, and you need to explain how it creates a deficiency. And in addition to that, you shall also express the required recommendations to overcome the limitations in the corporate governance. So these are the corporate governance principle. And the first one is leadership. And it is mentioned that it is responsibility of the company's board of directors to run the company, and they should be focusing on long-term success of the company, and they should never focus on short-term success. The next, we have studied that there should be clear division of responsibility between the person who runs the board and the person who runs the company's business. So the business will be run by the company's CEO, and the company will be headed, or the company's board will be run by the company's chairman. So the chairman and CEO should be separate person. There should not be unfettered powers for a single individual. Then the chairman will be responsible for the leadership of the board, and he will be responsible for ensuring that the company's activities are being properly carried out. Then, in case of a unitary board, which is a normal board structure, non-executive directors should challenge the executive directors, which means that they should be questioning all the strategies and policies adopted by the executive directors. Then, when it comes to effectiveness, we have studied that every person who is there in the board should be having proper skills, experience, independence and knowledge to carry out their duties properly. In addition to which, the board should be balanced. The board structure should be balanced, which means that there should be equal number of executives and non-executive directors. And there should be a formal, rigorous and transparent procedure for the appointment of the new directors to the board. So none of the directors should be selected without following formal structure. Every director should be selected formally, rigorously and on the basis of transparent procedures. And every director should spend sufficient time in discharging their duties. And whenever a new director joins the company, he should be provided with proper introductory training or the induction training. And we should be following proper measures to ensure that the skills and knowledge of the directors are up to date. Then, the directors should be provided with proper information on timely manner to carry out their duties properly. In addition to which, the performance of each of the directors should be evaluated annually. So we need to consider whether each of the directors giving their maximum output for the company. Then again, we need to consider whether the directors are being submitted for re-election on regular interval. So which means that every director should continue only for a maximum period of 2 years, and at the end of the 2-year period, directors should be re-elected. Then when it comes to the accountability part, the board of directors should be having a proper, balanced and understandable assessment about the company's position and the prospects. The board should also be responsible for making proper sound risk management and internal control system for the company. And the board should be properly following a formal and transparent arrangement in order to make sure that they are following the corporate reporting, risk management and internal control principles properly. And when it comes to the remuneration part, the director's remuneration should be designed in such a manner that to promote the long-term success of the company, and performance-related elements have to be included as part of the remuneration package, and make sure that the executive director's remuneration should be fixed only by remuneration committee, which is having 100% of non-executive directors, and none of the executive directors should fix their own salary. And when it comes to the non-executive directors, the non-executive directors' appointment should be done by the shareholders. Non-executive directors' remuneration should be fixed by the shareholders, and their remuneration should not be based on percentage-wise or contingent-wise or on the basis of the performance. It should be a fixed amount. Then, next one, relationship with the shareholders. It's the responsibility of the total board of directors to maintain satisfactory dialogue with the shareholders of the company. And whenever shareholders request to have details relating to any activities of the company, whole board should take up this responsibility. And finally, annual general meeting should be conducted, and the investors should be encouraged to attend the annual general meeting. So these were the corporate governance principles. And in addition to this, we have also studied detailed about the company's audit committee. As we know, every company, especially a publicly listed entity, is required to have an audit committee. So basically, when it comes to an audit committee, it should be consisting of a minimum of 3 non-executive directors. And out of these 3 non-executive directors, one should be financial expert and others should be financially literate to carry out their financial reporting responsibilities appropriately. And in addition to which, when a company selects a audit committee, in case of a small company, in that case only they are required to have 2 non-executive directors in the board committee. However, in that case also, both of them should also be having proper financial expertise to carry out their roles appropriately. So further, we have studied about the roles and responsibilities of the audit committee and all. So this is what you need to consider to give proper answers in relation to the audit committee. And you will be getting questions from this area. So let's look into the question. So there's a question called daily. Okay, so let's go through this scenario. During the year, chair of daily company, during the year, chair of daily company resigned due to other commitments, and Fred Johnson, who is the chief executive of the company, took over this role. Fred has recently written to all shareholders to inform them that any question or comments they have, any questions or comments which they may have could only be raised at the company's annual general meeting, and that any communication with the board is not possible. The executive director's remuneration is set by the remuneration committee. The non-executive director's remuneration is set by the board and is based on pre-tax profit target which are agreed by the board at the start of each financial year. As the board is of a view that internal control is very effective, audit committee has not been established. So we have got this scenario and we have got a requirement. Describe 3 corporate governance deficiency faced by daily company. Provide recommendation to address each deficiency and ensure compliance with corporate governance principles. So this is what it's mentioned in the scenario, right? So from this scenario, we need to identify 3 corporate governance weakness. Then we need to pick how does it represents a corporate governance weakness, and we need to give a recommendation as well. So what all are the corporate governance deficiencies in this case? So let's start with the first paragraph. Is there any corporate governance weakness in the first paragraph? Is there any corporate governance weakness? So it's mentioned that during the year, the chairman have resigned the company. Therefore, Fred Johnson, who is currently the company's chief executive, is planning to take up this role. So well, we know that it's a deficiency, right? Because as we discussed earlier, the chairman and CEO should be separate person. And the chairman should be an independent non-executive director. So the company's current chief executive, Mr. Fred, he is not an independent person to the company. And when he is taking up both the roles together, there can be chances of having unfettered powers which will be used to mislead the company's activities, and they will not be carrying out the operations of the company in accordance with the wish of the company's shareholders. So that will be the issue there. And what should be the recommendation? It's a very simple recommendation. What do you need to do? The Fred Johnson should be resigning as the company's chair, and instead a new non-executive director should be appointed as the chairman of the company, who will be able to maintain sufficient independence. So that should be the recommendation. Then what's the next issue in the scenario? So it's mentioned that if the company's shareholders need to have any other communication or information in relation to the company's activity, the company will not be able to provide that. Instead, they have mentioned that they will be able to raise questions or comments only during the company's annual general meeting. So that will be the another issue, right? Because when a company is not able to provide adequate amount of communication to the company's shareholders, the shareholders will not be able to express their interest. They will not be able to evaluate the policies or actions taken by the company's management. So there can be chances that the company might not be running in the interest of the company's shareholders, and the shareholders will be dissatisfied. And what should be the recommendation in that? The chairman should take up the whole responsibilities in ensuring communication with the company's shareholders sufficiently, and the board should be considered to have total responsibility to communicate to the company's shareholders. The chairman will be taking up the ultimate role in making sure that the whole board of directors take up their responsibility in providing satisfactory communication with the company's shareholders. So that should be provided as a proper response. Then again, it's shown in the scenario that the non-executive director's remuneration is currently being set on the basis of the pre-tax profit targets. So what will be the issue in that case? If the pre-tax profit related performance-based payment are provided to the company's non-executive directors, in that case the non-executive directors will not be considered as independent, because if there is any issue that the non-executive directors have identified which might result in reducing the company's net profit, so in that case automatically the remuneration of the particular non-executive directors will also be affected. So they will not be willing to lose their remuneration, so their independence will be affected. So you have to state it as the deficiency. And what should be the recommendation? Yeah, you need to mention that the remuneration of non-executive directors should not be based on pre-tax profit before tax. Instead, it should be based on a fixed amount, and any other performance related payments shall not be provided to the company's non-executive directors. Then again, it's mentioned that the company is currently not having an audit committee, right? And they are mentioning that the company's internal control environment as of now are very effective. So in case if the company is not having a proper audit committee as mentioned in the scenario, then the responsible person for overseeing the company's responsibility in relation to financial reporting and auditing will not be there. So there can be chances of having issues with the company's financial reporting. In addition to that, they will not be able to ensure the independence of the external auditors as well. And what should be the response? Yeah, we can mention that this company should consider maintaining an audit committee, and in case of establishing an audit committee, 3 non-executive directors should be appointed who are having sufficient experience and knowledge in accounting areas. So this is what you need to mention there. And to be precise, you can mention that the person should be having financial expertise and others should be financially literate. So this is what you should be providing as your answer while writing questions in relation to corporate governance weakness and its recommendation. So whenever you write a deficiency, you should be identifying the deficiency, explaining it, and you need to mention overall impact on the entity, and you have to provide a proper recommendation for the deficiency as well. Clear? Okay. So another important area which we need to discuss now is the area of ethics. So we have got an important area called ethics, which will be tested as part of our descriptive area, or definitely it can also be asked as part of our MCQ questions as well. So basically when it comes to the ethics part, usually we used to get a questions on fundamental ethical principles. So basically there are 5 fundamental ethical principles which every auditor or every ACCA professional should be following, which includes integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. So basically when it comes to integrity, it means that members should always be straightforward and they should be honest in all their business and professional relationship. And when it comes to objectivity, the members should always avoid any factors that might affect their business judgments. So all the conflict of interest possibilities should be avoided. Then when it comes to the professional competence and due care, an auditor should make sure that he is having proper competence to perform an engagement. So he should always be making sure that all of his knowledge are up to date, and in addition to that, he should be accepting an engagement only if he is having sufficient knowledge about the work. And when it comes to confidentiality, when the members obtain details of a client, he should not be disclosing the details to any other third parties unless there is a legal or professional duty. And again, if the auditor have obtained an information from a third party, the information should be used only for the purpose for which auditor have obtained it. So both of this will be considered as part of the confidentiality itself. And when it comes to professional behavior, members should properly comply with all the laws and regulation. Any action that might discredit the profession should be avoided. Then we have clearly studied that there are 5 fundamental ethical principles, and corresponding to the ethical principles, there will be some threats which might affect an auditor's independence or objectivity. And basically this includes 5 ethical threats, which are self-interest threat, self-review threat, advocacy, familiarity, and intimidation. So there will be self-interest, self-review, advocacy, familiarity, and intimidation. These are the 5 ethical threats. And when it comes to self-interest threat, it means that an auditor is giving more importance for his own personal interest rather than professional interest. So when an auditor gives more importance for his personal interest rather than professional interest, it will give rise to self-interest threat. So say for example, if the auditor is having a family or personal relationship with a member in the client company, so what will be the issue in that case? There can be chances of having a possibility that auditor might give a favorable opinion for the company, as the relation will be affected if an inappropriate opinion is given. So that's the self-interest threat. And there should be a safeguard which the auditor have to take in relation to this. What can we do? If an individual, say for example, if the audit manager's wife is working in the client company, we can do one thing, we can remove that audit manager from the audit team. So whoever who creates that family and personal relationship shall be removed from the team. The next one is gift and hospitality. If the client company is offering a gift or hospitality service to the auditor, and if the auditor accepts that, there can be chances that the auditor might give a favorable opinion. So to avoid that threat, what can we do as safeguard? We should decline all the gift and hospitality services offered by the client company. We should politely decline it. And if the loans or guarantee is taken by the auditor from the client company, there's also a possibility that if the loans and guarantee is taken, there will be cases where the auditor will not be able to give an unfavorable opinion to the client because they might ask us to pay back the whole amount of loan back. So auditor will be always having this fear. So what should be the case that in such a situation, if the auditor is getting a new engagement, auditor should not accept that. And if the auditor is having overdue fees, the client is pending to pay the prior year audit engagement fee. So the auditor will always be having a fear that if the auditor is giving a non-favorable opinion to the client, so in that case, client will not be willing to pay the prior year audit fees as well as the current year audit fees. So because of this fear, auditor might give a favorable opinion. And as a safeguard, ACCA have clearly mentioned that if the overdue fees is there, auditors should not continue with the engagement until the fees is settled. So the auditor shall continue with the audit engagement only once the audit fee is settled. Then, percentage or contingent fees. The client company is willing to pay auditor on the basis of percentage, maybe 5% of the company's profit. So if the auditor is getting a payment on the basis of the percentage of an element, then automatically there's a possibility that even if the company's profit is overstated, then the auditor will not be willing to correct that. Because if the auditor decides to reduce the profit to the actual figure, automatically the auditor's revenue will also be affected. So the auditor will not be willing to forgive their amount of remuneration. So it will result in self-interest rate. And what we can do to avoid that, we should be making sure that the fees should be a fixed amount or the fees should be charged only on the basis of the hourly rate. So the auditor can charge the fees on the basis of hourly rate. Auditor will consider the total hours which he have consumed in performing the engagement and it should be multiplied by the hourly rate fixed by the auditor. That total amount will be charged an audit fee. So the percentage or contingent basis fees will not be allowed. So high percentage fees. Consider that for the auditor, there's a client. For the past 2 years, the client have contributed almost more than 15% of the audit firm's revenue. So it's a significant client for the firm. So the auditor will not be willing to lose such a client. So auditor might do whatever things that will be able to be favorably done for the client company, that will be done from the auditor. So to avoid this, we should be taking a safeguard that we can use an external reviewer to perform the review of the work undertaken by the auditor to make sure that the quality of the engagement is not forbidden. And again, lowballing. The auditor have agreed to the client that they will perform audit engagement at a very low audit fee, and there can be chances that the auditor will reduce the quality of the audit in accordance with the reduction in the audit fee. So this is something called lowballing. And in case of lowballing transactions, the auditor is not allowed to accept such an engagement. So to avoid the situations, auditor can do one thing. When a client requests the auditor to perform the engagement at a low audit fee, auditor should make sure that auditor will be able to cover all costs incurred for the audit by charging the fees required by the auditor. Then only auditor should accept the engagement. In addition to that, external reviewer should perform the review of the work as well. So this is how we have studied the self-interest threat. So we have discussed all other threat in detail. So it's the same thing is mentioned in the question as well. So you should be considering the threat and safeguards in this manner. Then next one is self-review threat. So basically when it comes to self-review threat, consider that you have already performed a work for the client company which is relating to the financial reporting of the client. Say for example, the valuation service, tax service, corporate finance, other services, or you were recently working with the client company. In all this situation, you are the person who are responsible for performing the audit, as well as you were also responsible for doing some other work relating to financial reporting. So anyway, you will not be willing to mention that you have done a mistake in your prior work. So it will affect your work quality. So in order to make sure that this threat does not appear, it is the mandatory responsibility of the auditor to make sure that if the auditor is providing a financial reporting related service to the client company, auditor should not accept that client's audit engagement. Or if the auditor were already performing the audit engagement for the client company, and meanwhile the client is requesting you to perform an additional non-audit service, auditor should not accept that engagement if it is relating to the client's financial reporting. And one more thing, when it comes to listed entity only, this rule is applicable. However, when it comes to a non-listed entity, you are allowed to perform the work by using separate engagement team. But you should make sure that any person who is involved in the audit engagement should not be involved in financial reporting related tasks and vice versa. And next one is advocacy thread. And basically when it comes to advocacy thread, you will be performing a work that might represent the client company. So you will be representing the client company at a point. Say for example, the client is planning to take a new bank loan for which the auditor is required to appear to the bank to represent the client company. Or the client is facing a tax dispute and for which the auditor is appearing. In all these situations, there can be chances of having advocacy thread. Then, in case of an advocacy thread, whereby the client will be requesting you to represent the client, you should politely decline that. That's only safeguard available. And the familiarity thread will be normally created when there is a relationship that arises between the auditor and the client company other than their usual professional relationship. So any other personal relationship other than professional relationship will result in a familiarity thread. And the next one, when it comes to familiarity thread, you have to make sure that if the auditor is having any issues or if the auditor is getting any request from the client that might result in a non-professional relationship between the auditor and the client company, in that case, auditor should politely decline that engagement, or the auditor should politely decline the request raised by the client company. Say for example, the client is inviting the auditor to attend a party. So in that case, auditor should decline that. And finally, it's the intimidation threat. So basically, the intimidation threat will be arising in three situations. Case number one, consider that the auditor is performing the audit engagement, and meanwhile, the auditor is being threatened by the client company. So that is something called coercion. Client is trying to threaten the auditor. So say for example, client is mentioning that the auditor will be charged for some other issues that have been done during the audit engagement. They might be mentioning that the auditor will need to face a lawsuit which will be filed by the client company, or the client is mentioning that they will not be willing to provide the next year audit engagement. The client will not pay the audit fees on time. So in any matters which may rise to a threatening of the auditor, or if there is any situation which shows that auditor might be influenced by a person who is having authority over the auditor, it will be considered as an intimidation threat. And again, if there is any indicators of fact that shows that the auditor will not be able to perform the audit engagement appropriately, which means there are factors which shows limitations in the audit engagement. Say for example, if the auditor is not given sufficient evidence, if the auditor is not given permission to contact the company's finance director or discuss with any of the company's employees, or if the auditor is not given adequate notices of the meeting, in all this situation, it shows that, or again, if the auditor is not getting sufficient time in performing the audit engagement, all this will be considered as limiting scope of the engagement. It will be also considered as part of the intimidation threat. And whenever the intimidation threat arises, auditor should discuss this matter with the clients, those charged with governance and audit committee. And if they are not taking reasonable action, auditor shall consider resigning from the audit engagement. So that should be the proper safeguard that needs to be taken from the side of the auditor. Then in addition to each of this threat, there can be possibility of having management threat as well. So the management threat means that the auditor will be assuming management's responsibility as part of the audit firm's responsibility. So if the management's responsibility is considered as part of audit firm's responsibility, it will result in a management threat. Yes, and we have studied the related safeguard of each of the threats. In addition to which, you need to consider there will be several threats that might be arising when an auditor audits entities in a competent market or entities that trade with each other. So there will be some entities which will be competing in the same market, right? Say for example, there will be Apple and Samsung. Both of these are competitive companies. So the auditor is responsible for auditing both the Apple's and Samsung's financials. So this is what we consider as auditing multiple entities in a competent market. So in that case, there will be threat to objectivity as well as there will be threat to confidentiality. And the first step that need to be taken by the auditor is that they need to contact both the client company and we need to inform about the same issue, and we need to get permission from the client. And if the client is giving us the permission to continue with both engagement, we can continue with both engagement, or else we need to cancel off one of the engagement. And if the client is giving us permission, we need to consider these additional factors before continuing with the engagement. We need to consider whether separate engagement team will be available. Then we need to make sure that there will be procedures to prevent access to information. Confidentiality agreement have to be signed by each of the engagement team members. Then this safeguards should be properly reviewed by a senior official. And if the client is having any concern on how we will be maintaining the independence, then independence advice have to be provided to the client. So these should be the additional safeguards that should be adopted in order to accept this audit engagement. And if the auditor is not able to maintain the safeguards, auditor should consider resigning from the audit engagement. So always make sure that whenever you get a question on the safeguards to avoid conflict of interest, so these are the safeguards which you should be mentioning as answer to give us safeguards to avoid conflict of interest. So these are usually asked as part of our AA exam, as part of the ethics area, which is a very simple area. So in the introduction paragraph itself, they might have mentioned about the industry in which the client company operates, and you need to consider whether the client is also auditing any other company in the same industry. And if there is any other company in the same industry, there will be possibility of having issues relating to the company's audit engagement, and this should be taken as a safeguards. Okay, all right. So now let's do a question from this area. There's a question called Mac Pain in revision kit, and sorry, yeah, in the question P's. Okay, we'll do the question P's. So they have asked us to identify and explain two ethical threats which might affect the independence of Apricot and Company audit of Pete's company, and for each threat we are also required to provide safeguard. Okay. So now everyone please read this scenario in relation to the Pete's company. Everyone please read now. So now let's go through the scenario. The Pete's company has been an audit client of Apricot and Company for last 15 years. Audit staff of the Apricot company and the client staff of Pete's company have always enjoyed a meal together at the start of the final audit. Alan Edward, the managing director of Pete's company, has this year suggested that instead of a meal, all this audit staff and client staff go away for a weekend to a luxury hotel at the Pete's company's expense. Alan Edward also suggested that current year audit fees is renegotiated based on percentage of Pete's company's net profit for the year. This year, for the first time, Apricot company have approached by Pete's company to help identify potential acquisition target. Discussions are currently at the early stage and no work has been undertaken at present. Total fees in relation to the audit and other work would fall with the acceptable level in line with ACCA's Code of Ethics and Conduct. So this is what it's mentioned in the scenario. So we need to identify each of the ethical threats. So well, as we know, it's mentioned that the managing director of the Pete's company is telling us that they are planning to take us for a weekend holiday at a luxury hotel at the client company's expense itself. So what will be the ethical threat that will be created in situation? So probably this might result in self-interest threat and familiarity threat, right? Because the amount of this threat is significant Because when it comes to a luxury hotel, the client company might be spending a significant amount for us. So the value is not trivial. So it will affect the self-interest of the auditor. In addition to which, a non-professional relationship will be created here, other than the professional relationship as an auditor. So it will result in familiarity threat, and it might affect the independence of the auditor. And what should be the safeguard which we need to take in this case? So there's only one safeguard. The auditor should communicate the matter. The auditor should discuss the matter with the client company's finance director and should inform them that the auditor will not be able to take up this offer provided by the client, and the offer should be politely declined. So that should be the safeguard in this case. Then secondly, the client company have mentioned that the fees will be based on the company's net profit. Well, we know that when the fees is based on net profit of the company, it will be resulting in a percentage or a contingent fees leading to self-interest rate. Because in case if the profit of the client company is misstated, auditor will not be suggesting appropriate accounting treatment, as the remuneration of the auditor will also be affected by this. And what should be the safeguard? The auditor, which means you can mention the audit client's name as well. Apricot and Co. should mention the matter with the client's audit committee and those charged with governance, and should inform them that the fees will not be based on percentage or contingent basis. Instead, the fees should be a fixed amount. Then, next, it is mentioned that the company is currently planning to acquire some other entity, and for which they have requested us to perform the due diligence engagement, right? Because they have asked us to identify the acquisition target. So what will be the issue here? So if we start searching for the acquisition targets for each company on their behalf, it will be almost like representing the client company, right? So representing the client company might result in advocacy threat, as the auditor will not be able to talk against the client company once we have represented them. And what should be the safeguard? So the primary safeguard will be the fact that if it is not mentioned that it's a listed client, the audit company, that the Apricot and Co. should consider using separate engagement team to perform the due diligence work. And in case if there are no sufficient resources to use the separate engagement team, then auditor should inform those charged with governance that they will not be able to take up the additional services requested by the peace company. So this should be the safeguard. So these are the basic ethical threats and safeguard in this scenario. And in addition to that, you can also mention about the client company's long-term relationship with the audit firm. That is, the audit firm is providing audit work to the client company for over 15 years. So it can also lead to familiarity threat. So you can mention, and you can also give safeguard as rotation of the audit engagement partner. So these are the ethical threats and safeguards which are mentioned in the scenario in relation to peace company. So this will be the way in which you will be getting questions from the area of corporate governance, ethics and reporting. So please do revise this area, and in the last day session we have discussed about the substantive procedure and the way in which we have to answer the substantive procedures. So please do go through that video as well. And in the next session we will be discussing on other areas of the AA. So we'll meet you in the next session. So please do share this video with all the possible students who are planning to attend our upcoming ACCA AA exam. So thank you so much everyone. All the very best for your exam. Do prepare well, practice maximum number of questions as possible. So thank you so much everyone.